The European Central Bank, the ECB. Welcome to Money and Good Sense. The European Central Bank, better known as the ECB, regularly appears in the news. Whenever interest rates change, inflation rises, or the economy slows down, you will often hear about the ECB. But why does the ECB actually exist? Why does Europe have one central bank for so many different countries? And why do the ECB's decisions affect your savings, mortgage, and the economy as a whole? In this video, we will look at how the ECB was created and the role it plays within the Eurozone. Because to understand the economy, it is important to understand the institution responsible for monetary policy in the Eurozone. Why does the ECB exist? Before the euro was introduced, every country had its own currency and its own central bank responsible for monetary policy. That changed with the introduction of the euro. Today, 20 European countries share the same currency. It would not make sense for 20 countries to use one currency while each country followed its own monetary policy. That's why a single institution is needed to determine monetary policy for the entire Eurozone. That institution is the European Central Bank, or ECB. The ECB is responsible for the monetary policy of all countries that use the euro as their official currency and aims to keep the euro as stable as possible. The ECB's main objective. The ECB's primary objective is to maintain price stability throughout the Eurozone. In other words, it aims to keep the value of the euro as stable as possible. To achieve this, the ECB targets an inflation rate of around 2% per year. Why the ECB aims for approximately 2% inflation is explained in detail in our video What is a Central Bank? In short, the ECB tries to prevent inflation from becoming too high, while also avoiding a prolonged period of deflation. To achieve this goal, the ECB continuously monitors economic development and price levels. Whenever necessary, it can take measures to help bring the economy back into balance. Interest rates. To keep prices as stable as possible, the ECB uses several monetary policy tools. By far the most important of these is the policy interest rate. When the ECB raises interest rates, borrowing becomes more expensive. As a result, households and businesses usually borrow less and spend less. When the ECB lowers interest rates, borrowing becomes more attractive. This often leads to more investment, higher spending, and stronger economic growth. We explain this process in much greater detail in our video about inflation, productivity, and central banking. For the ECB, interest rates are the most important tool for slowing down or stimulating the economy. The relationship with commercial banks. The ECB does not deal directly with consumers or businesses. Instead, it mainly works through commercial banks. As we explained in our video, What is a Central Bank? Commercial banks can borrow money from the ECB when they need additional liquidity. They can also deposit excess funds with the ECB for a short period of time. Because the ECB determines the conditions under which commercial banks can borrow or deposit money, it has a major influence on interest rates throughout the economy. Commercial banks pass these costs on through the interest rates they charge on loans and the interest they pay on savings. In this way, the ECB ultimately influences the financial decisions of households and businesses without lending money directly to consumers. Other responsibilities. Although interest rates are the ECB's best-known policy tool, its responsibilities go far beyond that. The ECB also helps safeguard the stability of the financial system and, together with the national central banks, supervises the largest banks in the Eurozone. In addition, the ECB is responsible for authorizing the issuance of euro banknotes and supports the smooth operation of payment systems across the eurozone. Interest rates receive most of the public attention, but these responsibilities are just as important. Do individual countries still have a say? A question that is often asked is whether individual countries still have any influence over monetary policy. The answer is yes. Each Eurozone country still has its own national central bank, and together they form part of the euro system. The governors of these national central banks, together with the members of the ECB's executive board, participate in the meetings where monetary policy decisions are made. These decisions are taken collectively. Once a decision has been made, the same monetary policy applies to every country that uses the euro. So individual countries still have a voice, but the Eurozone ultimately follows one common monetary policy. Conclusion: the European Central Bank is much more than an institution that occasionally raises or lowers interest rates. It determines monetary policy for the entire Eurozone and aims to keep the value of the euro as stable as possible. To achieve this, it works closely with the national central banks of all Eurozone countries. Although most people never deal directly with the ECB, its decisions affect the economy and ultimately our everyday lives. They influence mortgage rates, savings rates, inflation, investment, economic growth, and even employment. That is why the ECB appears in the news so often. And that is exactly why it is important to understand the role it plays. Behind many of the economic developments we hear about every day lies the monetary policy of the European Central Bank. I thank you for watching. And as always, don't worry too much. Everything can be overcome with study and patience.